Crypto. All the crypto news in one place.
Look at the fear and greed index, as this is usually a pretty decent indication as to where the sentiment is, of course, and then it usually ties in pretty nicely with some of the analysis as well. So for crypto, we are yet again back in extreme fear as of 16 hours ago. So this is reporting over basically the weekend here.
Now, some traders are even saying we will probably see a lower price for Bitcoin. Saying maybe even $58,000 for one Bitcoin. Now, the big discussion here will be, of course, was the macro tension the only reason why the Bitcoin price has dropped, or was it because a dormant Satoshi-era wallet has moved around 909 Bitcoin, or about $84 million after 13 years? Now, this whale has moved their Bitcoin, which they bought around in 2013 for $6,400. By the way, the equivalent of investing into the S&P 500 back then would have netted them $37,000, and investing that into gold would have brought them 150% of gains. So obviously, the Bitcoin trade was the better trade, but the big question is, what will they do with their Bitcoins? Now, one of the reasons why Satoshi-era wallets are being moved is because of the quantum risk.
People are just buying constantly. And for people that are holding it, there's just no Bitcoin price that is too high. Like, you're trying to escape a collapsing fiat currency, you get on the nearest lifeboat. Then you have the ETFs, and I think this is a big catalyst that has not been tapped into yet. We see a lot of inflows, more so than outflows, but the ETFs effectively remove the barrier to buying Bitcoin that has dampened a lot of prior bull runs. Bitcoiners accumulating regardless of the market sentiment and quantum FUD or whatnot. And then you have fiat collapse. And a lot of people don't understand how easy it is for fiat to collapse, but you just look in recent weeks. Fiat collapse is infinite bid, but we have 7, 8, 9 different things that are pushing to infinite bid. So we've kind of lost our way as a civilization.
We have Yoshitaka Kitao, SBI CEO, responding to a Japanese crypto news source, and that is crypto ETF set for approval in Japan by 2028, broadening asset management opportunities. Now, we have from Kitao, and he says, too late. So 2028 is way too late for a crypto ETF, especially when we do have the bull run beginning this year in 2026. We do have the super cycle happening, the bull run continuing, extending to 2026. And so, guys, we do want the ETFs as soon as possible, definitely for this year, as we will see cryptocurrencies moving up even higher with these ETF launches.
Right now, BlackRock is placing their bets on Bitcoin. If they weren't placing their bets on Bitcoin, they wouldn't have applied for this brand new ETF. And some of you might be saying, oh, you know what, the crypto market's not pumping, blah, 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 blah. Guess what? These big companies are able to hold on to unrealized gains and losses for a long amount of time. And they're incredibly particular as to what they're doing. If we're talking about the stock market is a massive Ponzi. And just this particular TradFi product that BlackRock just filed for, it's going to track Bitcoin price while generating premium income by selling call options on IBIT. So it's tracking Bitcoin price, but it's also following the income by selling call options on IBIT. It's a derivative on a derivative. Moral of the story is pay attention to what big money is doing and leave your emotions at the door, and diversification is key.
Let me show you this on the screen. About 20 minutes ago today, CZ Binance saying the following, and I think if you're holding crypto, if you're watching the channel, if you're here saying, man, it's tough, I'm tired of the manipulation, of the volatility. Just give me my money and I want to just leave. Let's listen. AI will make you jobless. Crypto will make you not need a job. Buy and hold now, retire in a few years. If crypto, raise your hand. If crypto allowed you to retire already, not financial advice. I like this, guys. I want to touch base on this.
What does this mean for Ethereum? What does this mean for Pulse Chain? Ethereum's leading the way in security and innovation. Now, they're not innovating super fast and like cutting edge like this stuff, but you'll find that a lot of these altcoins, when their whole premise is based around a narrative of, oh, we do this one thing slightly differently, we're quantum resistant, and that's like our claim to fame. Guys, Ethereum can just take that as research. And when they do their R&D, they're just going to incorporate quantum resistance into Ethereum. They're already telling you the playbook. This guy, Justin Drake over here, this is just 3 days ago, he announced a post-quantum team led by a bunch of Giga Chad, big brain tech guys. Okay, these guys are basically funding with millions of dollars of grants, and they're going to build post-quantum in Ethereum. And then what does that mean for Pulse Chain? Is Pulse Chain going to be quantum resistant? The answer is yes. As soon as Ethereum is quantum resistant and it's proven that it works fine in the real world, Pulse Chain gets to inherit that because Pulse Chain is a clone of the code of Ethereum. So that's the beauty of being in stuff like ETH, being in stuff like Pulse. You don't have to worry and freak out.
It's on the blockchain rail. They're going to have all the tools in the world to see everything that's happening in real time, and they'll be able to take advantage of that information for better or for worse. But remember, there's also the bankers. And what do the banks want? Well, preferably to kind of keep it all the same, but really their biggest goal right now is to avoid the privatization of money. Here's one of the central bankers at Davos saying exactly this.
As I am a central banker, let me insist a bit on at least I gave a speech 2 weeks ago with a triangle of threats and a triangle of answer, but let me sum up. The first threat is privatization of money.
So in other words, they want to not be what's called disintermediated, meaning they don't want to be cut out of the capital flows. They don't want to be made irrelevant. How do they do that?
Here the answer is CBDC.
Central bank digital currencies, CBDCs. This is how the old system is trying to stay relevant. Because if cash is disappearing, if private payment rails are taking over, if tokenized assets are routing around them and asset managers are building this new infrastructure without the banks, well, that shrinks the power of the banks. So CBDCs are a way for the central banks to have their own programmable money.
The world must move faster towards digitized currencies under a single unified blockchain to reduce corruption. He outlines a vision where every asset is placed on one system, including stocks, bonds, real estate, money market funds, and cash. In that system, ownership would be tokenized, fractionalized, programmable, and instantly transferable on one all-encompassing blockchain ledger. Listen closely to this video clip.
I think the movement towards tokenization, decimalization is necessary. It's ironic that we see two emerging countries leading the world in in the tokenization and digitization of their currency. That's Brazil and India. I think we need to move very rapidly to doing that. We would be reducing fees. We would do more democratization by reducing more fees if we had all investments on a tokenized platform that you could move from a tokenized money market fund to equities and bonds and back and forth. We have one common blockchain. We will, we can reduce corruption. So I would argue that yes, we have more dependencies on maybe one blockchain, which we could all talk about. But that being said, the activities are probably processed and more secure than ever. I think the movement towards
Now, when you have someone like Larry Fink talking this bullish about something, you need to look under the hood. Because again, we are being sold on something.
So as we go, we know the Senate Banking Committee has postponed their markup, but we had the markup from the 27th to the 29th now because of the snowstorm on the East Coast. I get it. I'm not panicking. It's due to weather. It's no other reason. That weather was nasty on the East Coast, for those that don't know. And now it's just cold and bitter. Feels like everybody working down in D.C. Just cold, bitter. So we're going to find out how that goes. I believe they're going to reach a deal, as I said, even though a deal for, I think they're going to figure it out by the 29th. Maybe the 2 extra days was, something bigger than all of us. And that weather storm gave them some extra time to get things done and hammered out to make this happen. It's very optimistic. The Senate Agriculture's Committee's updated legislation to regulate cryptos will advance.
The flip side, though, to the weaker dollar for the U.S. is obviously we've got a huge amount of debt. And that's helpful. How do you think that plays into it at all?
Well, foreigners still hold about 30% of the U.S. Treasury market. While that's down from 50% about 10 plus years ago, they still hold about 30%. If that continues to go down, well, then the U.S. Treasury is going to have to find other investors, whether it's U.S. retail, U.S. institutional, stablecoins, or whatever. So I do think that because of that very large ownership of U.S. bonds and stocks from foreigners, further weakness in the dollar could sort of disrupt those flows. And if we do get a joining of this industrial and precious metal bull market with oil because of a weaker dollar, well, then that complicates the inflation story. It complicates the job of the Fed as well.
Peter, Tim, and foreigners who've been hedging a lot of this dollar exposure may decide not to do that.
Let's listen to French Hill on the Clarity Act.
Where we stand today with this?
Well, Cheryl, it's great to be with you. This is really an important priority, not only for President Trump, but for Republicans here in the House, where we've worked for 4 years on market structure legislation, and we've passed it twice. We passed it in the last Congress, my bill called Fit 21, and then this Congress, just last July, we passed the Clarity Act, which is what the Senate is debating. And the Clarity Act got 78 Democratic votes here in the House. We lay out the strict rules for market structure on how to treat a digital asset as a commodity or as a security, how you store it, how you can custody it, how it can be used for collateral, how banks will interact with digital assets. So it's a very important.
The banking part is the issue, okay? And the reason why it's an issue, and I know I beat this with the dead horse on the channel. I'm never going to stop doing it. But the banks in crypto is very, very important. You have to understand everything will eventually be digital. We're going to have stablecoins is all the rage right now with the institutions. That's why the crypto markets aren't moving. But eventually we're going to have fiat currency is going to be digital. And if we back down on the yield now, when banks are actually doing a lot.
Now, this is a huge week for equities, a huge week for economic data too. We have consumer confidence coming out tomorrow. And then Wednesday, we have the FOMC interest rate decision. As per usual, we pretty much know what's going to happen going in, that we're not going to see rates cut, but how Jerome Powell addresses the market and talks about what their plans are for the future. How he talks about this is going to be more important than what they actually do. So a lot of people will continue to watch Jerome Powell because a lot of people want interest rates lowered. Then we have initial jobless claims on Thursday, the trade deficit delayed report, U.S. productivity revised, wholesale inventories. And then Friday, we have PPI and core PPI. This is a leading indicator. This is the producer price index, so maybe gives us an idea of what CPI will be in the future. So big end of the week there between the FOMC and initial jobless claims and then PPI.
We've seen tariff threats in Greenland, but historically, Fed rate cuts have reduced the yields on treasuries and money market funds, lowering gold's opportunity costs. Okay. For note, China has been buying gold for 14 consecutive months. Poland Central Bank recently approved a major purchase, and cyclically, we have seen a lot of these kind of go hand in hand as investors are turning to alternative assets to find safe haven in terms of their trading. Okay, but three of the risks that are kind of pending as we do look in this market beyond the flock to gold. That's the U.S., Canada, China tariff clash we have seen within a new trade agreement with U.S. and Mexico. The commitment not to pursue free trade agreements with non-market economies without prior notification. So that's kind of where we look into that response, saying that Trump called this one of the worst deals in history. Okay. And saying that we can't let Canada become an opening that the Chinese pour their cheap goods into the United States.
Everyone is talking about this government shutdown because the next day on the 30th, this is essentially the time where we would see that funding expire, which will lead to a government shutdown. We have here that the U.S. government shutdown could happen again in 6 days. This was on the 25th, so it's actually now, 3 days from, today. And we have Polymarket now shows a 78% chance of a shutdown. The odds are rising because Senate Majority Leader Chuck Schumer, the top Democrat in the Senate, said Democrats will vote no on the funding bill. The Democrats are opposing parts of the bill related to DHS and ICE, while Republicans want to expand funding and powers. Both sides are stuck and time is running out. Funding expires on January 30th. If Congress fails to pass the remaining bills, a shutdown begins. The last shutdown lasted 43 days and damaged the economy. No one wants a repeat, but without a deal on ICE, there are not enough votes to avoid it. Now, I'm hopeful that crypto can avoid having that downtrend begin and us just chopping if we do get another shutdown. It's questionable on what will happen. Obviously, the economy doesn't like shutdowns because it does damage the economy, which means that the financial markets also don't like shutdowns.
Speaking of debt levels, look at the public debt. I mean, this is insane. Going all the way back from 1970, look where we are now. I mean, and look at this rise from 2020 to 2025. Sure, we came up from 2015 to 2020, right? I mean, certainly, 18 million to 23 million. This is federal debt. And now we're sitting here, look at this, 37 million. But people buy insurance when we have these big debt levels, when we have big interest costs, political and geopolitical uncertainty, and a growing desire by countries to diversify their reserves. Here's total public debt as a percent of gross domestic product. Federal debt. So you guys can see what's happening here, right? So this is the 1 year. Here's the 5 year. Here's the 10 year. Look at our max chart, just continuing to go up parabolically. So the U.S. total public debt, as we just showed, was about 37 trillion in Q3 20.
The Fed is signaling yen intervention just like 1985. And again, last time this happened, it crashed the dollar by nearly 50%. Back then, the dollar was too strong. Exports were dying, trade deficits were exploding. Congress was ready to torch Japan and Europe with tariffs. So the US, Japan, Germany, France, and the UK met at the Plaza Hotel, and they made a deal. Sell dollars, buy other currencies, weaken the dollar on purpose. It worked. Over the next 3 years, the dollar index fell almost 50%. USD JPY went from 260 to 120. The yen doubled. That was one of the largest currency resets in all of history. And when the governments coordinate in FX, markets don't fight them. They follow. A weaker dollar sent gold higher, commodities higher, non-US markets higher.
I think one interesting thing also with Japan and the yen is one of the cheapest currencies in the world versus the US dollar. But it can maintain that cheapness, or maybe it reverses. I think an important other currency to keep our eye on here is the Chinese yuan, which is quietly at the highest level since May 2023 against the US dollar. Chinese yuan doesn't rally like that for no reason. It is a purposeful rise, and if the Chinese yuan can rally, it can give room for the yen to rally and other Asian currencies to rally. Therefore, this dollar weakness, which I think is going to continue, could really broaden out amongst a variety of different currencies. And with so much foreign ownership of U.S. assets, foreigners are going to have two choices. Am I going to hedge up my dollar holdings, or am I going to start selling my dollar holdings, or at least buy less of them?
Peter, it's interesting. What point does dollar weak? It's historically a tailwind for U.S. equities. I get it. At what point, in your opinion, is it become a headwind? And maybe not in the form of dollar yen because it's its own animal, but dollar euros at levels we haven't seen in a while. I think it's headed to 125.
All right, so the week started on rather a calm note across the US and European equity markets. This is actually the first Monday since this year started that we could say that. The week started rather calmly for equity markets in Europe and in the United States. The rally in gold and silver stole the spotlight as gold burst past $5,000 per ounce level yesterday and silver past $100 per ounce level. Both spend the day giving back gains, but both are again strongly bid in Asia. Now, a part of the move is speculation. There's no doubt about that. The gold's volatility index, for example, spiked to the highest level since 2020, suggesting that we will more likely than not see a sizable downside correction from the actual levels and probably in the foreseeable future. But the fundamentals that push these metals prices to these levels today remain very much alive. The exploding US debt level and potentially inappropriately dovish Fed policy down the line make the US dollar increasingly vulnerable to inflation. In other words, increasingly vulnerable to further value deterioration. And the US-induced trade and geopolitical tensions threaten the appeal of the US dollar as the world's reserve currency.
The gold and precious metal markets, they're bifurcated. You have spot, which is easy to buy, almost impossible, if not impossible to sell at market rates. It's almost an eternal September. And now it seems people are suddenly interested in hard assets again. But it's almost like they need to relearn the challenges with gold. And I met a Bitcoiner last year. His journey actually came from gold. So he bought a lot of gold, and then he had a lot of problems selling the gold because, it's easy to get the gold, but how do you get rid of the gold? And he found that there was massive amounts of slippage. But when you're selling it, you're going to take a haircut off of that because it is so difficult.
There's a couple of silver bugs out there that actually have a conscience, okay? Most of them don't. Most of them are telling you to buy at all-time highs and above, like as prices are skyrocketing. Buy, go all in. That's what I've been seeing. Oh, it's going to go to silver's going to go to $300,000 or $300 or $500 or $1,000. Some of these guys are saying it might be wise to take some of those profits off the table. At least get your cost basis out of it. And I think that's smart. Like if you want to diversify, now might be the time, because keep in mind that the US dollar hasn't lost a ton of value, the DXY, since silver and gold have been rocketing up.
The US dollar has been falling. We're at 96.9 now, which if the US dollar is falling and assets are measured in US dollars, you would expect those assets to rise, especially if their narrative is around digital gold being that savior there, that safe haven for us to store our value and continue to buy and hold. Yes, we want to have some times to buy it cheaper, but it's not doing what it's supposed to be doing through these periods. And it's happened many times in history for Bitcoin. So I'm not sure whether the market is figuring this out and possibly thinking, look, it's just not going to work.
And if we take a look at Bitcoin right now, there was a nice little level of security, the 100-week moving average. And we're kind of bouncing around on that, a level of support, as the TA folks say. But as you can see here, it dropped below that. And the next level down is the 150-week, that's 70,000. And then if we get to this 200-week moving average, which is where everybody wants it to go, because that pretty much would indicate the bottom. It did that in 2018, did it in 2022. So I don't see why it doesn't do this again. If that's at 58,000. Ouchie. So we'll see. Anyhow, that's it for today.
We most recently bounced from. So yes, Bitcoin still looks very, very dangerous, but there are some very interesting signs, like I told you in the beginning of this video, that there is right now a big shift happening what smart money is doing. Because if you're going to be looking back at the last few years on Bitcoin, always, whenever the big Bitcoin wheels on Bitfinex are all going long here, it usually tends to be marking the bottom. At least this marked the bottom in September 2024. This marked the bottom in April 2025. And now, once again, while prices are sitting extremely low, we're seeing massive accumulation from Bitcoin whales here, opening up big long positions. And to be exact, more than 73,000 Bitcoins in long positions are right now open. And that is a significant sign that right now a big shift is happening. So smart money is heavily accumulating. And yes, after the most recent correction, because if I'm zooming in towards the price action actually, and going to compare to each other, you see Bitcoin dropped even further and the wheels are right now going on a heavy accumulation spree here. So there is clearly something changing right now here in the behavior from these wheels here. And truly, historically, this has always indicated a bottom in the market.
I want to show you why it's extremely obvious that Bitcoin is not done with its bear market. And I also want to show you, more importantly than that, how you can build wealth through this bear market. So buckle up, just give me a minute. I'm not here to attack you, but I do want to help you, and I want to help you see that there is an excellent investment opportunity on the horizon. And for those of you that are going to listen, I think you're going to be glad. All right, let's go ahead and start. Why are we looking at the smiley face of doom pattern? Well, quite simply, Bitcoin has printed the exact same pattern twice now in its history. We have seen Bitcoin rally up to a level, correct, rally up again, and then fall then we would go into a bear flag and fall even farther. That's exactly what we're seeing happen right now. We rally, fall, rally to a slightly higher high, fall, go into a bear flag, and then that bear flag points us to the downside. There are a lot of similarities here before we get into gold and stocks and balance sheet and all of this stuff that we're going to cover today. But I want to start out here. You also have these uptrending level of the uptrending level of resistance on the tops that corresponds with weekly chart downtrending level of resistances on the RSI. This is classic bearish RSI divergence, and this is bearish RSI divergence that is playing out on the weekly chart on the order of a year. So this is large enough bearish RSI divergence to trigger a bear market.
So we'll take a look, and that's swing up to swing up, swing down to swing down. That's hidden bullish divergence on the monthly. It tells you you're going to break these highs before you break this low. I've seen it hundreds of times in my life on many different assets, and everyone thinks you're going to dump. You sit here for a while too, and everyone says, oh, it's going to go down, but it doesn't. It eventually retraces back to the upside, and it gets everybody absolutely annihilated. I've seen it so many times, so just be careful. If you see it rip, be like, damn, man, that guy was telling me about it for months now. I've been saying it for 2 months straight. If the bears were that strong, why we should be down by now? The bear, they had all this momentum. What happened? You got to ask yourself that question, like, what happened to the bears? Right?
Let's switch to Bitcoin, which looks quite different from the chart we just looked at. So clearly, it's not behaving like digital gold at this point. That much we can say. And from a technical perspective, exactly like Mando said, this has not turned yet. Of course, it could be that this range here and ends up holding and it reverses from here, but that's pure speculation at this point. This is a wedge that broke on the downside. The trend is still down. It hasn't turned yet. And then, of course, we don't know about the future, but there's no clear signs of this turning yet, exactly like Mando said. So that's what we can see in the Bitcoin chart.
One thing real crude to point out here is we did have that big breach down to low 80s a while back, but ever since then, the 85K has held up very well for the last 3 months.
It has, absolutely. So that's, if I remove these, it's perhaps that's clear.
Last time we hung out there about 100 days. Right now we're at about 70 days. Now, if we were to lose the 100-week moving average, fall to the 200-week moving average, you were looking at a $68,000 Bitcoin. But I said I found something hopeful in the charts. Now, when you combine that with what BlackRock's doing, we're about to offer more Bitcoin exposure to more clients. This made me think that maybe we're not going to see that 200-week moving average. First thing I want to show you is a bull div that is now forming. This is a super rare weekly bull div. And if you look, when is the last time we had the same similar situation? It was at the bottom of the 2002 bear market. We would start, let me zoom in and stretch this a little bit. We would start, after we fell, this is about a week after we lost support here at the 200-week moving average, all-time low for the RSI right here. But it wasn't the first time we saw the bull div, which is right here, where things started to pump. It would actually take an additional 63 days. It would take an additional 2 months before Bitcoin would then print another bull div and then take off like a rocket. So I am not going to say we might not test this bull div for maybe an extended period of time, but it is super, super rare to see a weekly bull div.
So, did you enjoy the Zap? Let me know in the comments.